Hello and good evening, everyone. My name is Yasser Gulfraz, and I'm your tutor for today's session. Welcome to our lecture 3 of Economics and Accounting series. Today, we will focus on important aspect of financial accounting. Okay, so let's get started. Indicative contents. To understand financial accounting, we need to explore key topics that build a strong foundation in financial management. So these topics include importance of recording financial transaction accurately, uh, understanding income, expenses, assets, liabilities, capital, how to complete financial numbers correctly, structure and significance of an annual financial report, reason why financial statement need to be interpreted, methods used to analyze financial data, understanding accounting periods and their role in financial reporting, the use of accounting estimates, including depreciation, inventory, valuation, accounts payable, accounts receivable, and financial provisionals. Key terminology: revenues, turnover, total income earned from goods or services before deducting cost of goods sold, direct cost related to producing goods and sold by a company, operating expenses, depreciation and amortization, international financial reporting standard used by publicly listed companies in the UK for financial statement, HM Revenue and Customs or HMRC, the UK tax authority overseeing corporate taxes and VAT compliance. Uh, Video here to gain some understanding of financial accounting concept. I will recommend that watch this video. So this will use this link, and this video will help clarify key ideas and provide a real world example of financial accounting principle in action. Right, to able to apply key concepts in financial accounting. To apply financial accounting concepts effectively, we must understand the key steps involved in financial reporting and analysis. Recording financial transactions. Financial transaction must be recorded accurately to maintain proper financial record. Double entry bookkeeping system ensures that every transaction is recorded in two accounts, one as a debit and the another as a credit. So the keeps in accounting equation, assets is equal to liability plus equity balanced. So for example, if a business buys office equipment with cash, it records a debit entry in the office equipment account, increase assets, and a credit entry in the cash account, decreasing cash. This process helps maintain accurate financial records and balance. Uh, Next is preparing financial statement. Financial statements are essential tools that helps businesses and stakeholders understand financial performance. The main type of financial statements are income statements or profit and loss statement. This statement summarize revenue and expenses over a specific period to determine profit or loss. Balance sheet, this provides a snapshot of business financial position at a given time by listing assets, liabilities, and equity. Cash flow statement, this statement tracks cash inflows and outcomes from operating, investing, and financing activities. It helps businesses understand liquidity and ensures they have enough cash or cover short term expenses. Businesses prepare the financial statements regularly, monthly, quarterly, or annually to provide insights for decision making. For example, an income statement helps management evaluate profit margins, while a cash flow statement helps determine whether a business can meet its financial obligations. So, by understanding and applying these concepts, businesses can maintain accurate financial records, make informed decisions, and ensures long-term financial success. Next, applying key accounting principles. Accounting principles are important because they ensures financial records are accurate and consistent. Some key principle includes accrual principles. This principle states that revenues and expenses should be recorded when they are earned or incurred, not when cash is received or paid. Matching principal expenses should be recorded in the same period as the revenue they help generate. For example, if a company spends money on advertising to a boost sale, the advertising expense should be recorded in the same period as the sales revenue. Historical cost principle assets are recorded at their original purchase price rather than their current market value. This approach ensures financial records remain objective and verifiable. Applications, these principle helps businesses maintain accurate and reliable financial statement. For example, under the accurate principle, a company records sales revenue when it's earned, even if the payment is received later. This ensures financial record reflect the true financial position of the businesses. Using financial ratios for analysis and budgeting and forecasting. Financial ratios help businesses analyze their financial health. The main type of financial ratios include profitability ratio, liquidity ratio, leverage ratio, and efficiency ratio. Ratio analysis basically helps businesses make better decisions. For example, if a company's liquidity ratio is high, it indicate that the businesses can meet its short-term financial obligations. Strong profitability ratios may show a competitive advantage. Budgeting and forecasting are essential for financial planning. Budgeting budget preparation, businesses creates budgets to estimate future revenue, expense, and cash flow. uh, this helps in planning and resource allocations. Forecasting use past financial data to predict future performance. And variance analysis, business compare actual results with the budget to identify differences and take corrective action. Effective budgeting and forecasting helps businesses prepare for financial needs. For example, if a company expect a sale increase in a specific season, it can budget for a higher inventory purchase in advance. Depreciation and amortization and inventory and valuations method. Depreciation, business use depreciation and amortization to spread the cost of assets over time. Amortization, similar to a depreciation, the method spread the cost of physical assets like machinery and equipment over their useful life, reflecting their usage. Amortization, similar to depreciation, amortization applies to intangible assets like patents and trademark. And then methods, the two common methods are straight line depreciation and decline balance method. Straight line method, asset cost is divided equally over its useful life, and decline balance method, higher expenses are recorded in the early year, decreasing over time. Inventory valuation methods, uh, businesses must choose how to value their inventory, which affect their financial reports and taxes. FIFO, first in, first out. The older inventory is sold first, meaning the cost of goods sold reflects older prices. This method often lead to higher profit during inflation. LIFO, last in, first out. The newest inventory is sold first, which can result in lower profit when prices are rising. So weighted average cost, this method calculates an average cost of all inventories item. Any question so far, if anyone is there? Right, cost control and break-even analysis and auditing and compliance. Businesses needs to control costs and determine the minimum sales needed to cover expenses. Break-even point, this is the level at which total revenue equal total costs, meaning the business make neither a profit nor a loss. External audit. Auditing ensures financial accuracy and compliance with laws. Then compliance companies must follow financial laws and regulations such as IFRS and GAAP. So application audit enhance trust and reliability. For example, annual audits ensures investors that financial reports to accurate and transparent. Again, summary double entry key books ensures balanced account of each transaction's financial statement inform management and stakeholders. Accounting principles provides consistency and accuracy. Financial ratios supports businesses analysis and planning. Budgeting and forecasting guides spending and resource allocations. Depreciation and amortization reduced assets value and impact taxes. Inventory valuation influence profit margin and taxes, aids in pricing and investment decisions. Break-even analysis, auditing and compliance verifies accuracy and or adherence to standard. Right, conclusion for this particular section. By applying financial accounting concepts, businesses can create accurate financial statements, control cost, and plan for future performance. Following accounting principles ensures regulatory compliance and improves decisions making. These concepts helps businesses attract investors, remain competitive, and achieve financial stability. Next, we'll move to next section, which is process simple accounting statement using the double entry system. So, introduction to the double entry style to process simple accounting statement using the double entry accounting system. This system is the foundation of financial accounting, ensuring that financial transaction is recorded accurately in two accounts, one as a debit and the another is as a credit. Double entry system helps businesses keep track of financial activities, ensuring that their books remain balanced at all time. It follows the basic accounting equation. This means that for every financial transaction, there is an equal and opposite effect on two different accounts, ensuring the equation remains balanced. Here are some examples. The owner invests £5,000 cash into business. Business buys equipment for 1,500 cash. Business makes its sales of 1,800. Business pays 300 in cash for rent. The business receives a potential payment of £400. So each of these transactions will be recorded in the books using the double entry method. So if you look at here, the first one is uh, accounts affected cash debit 5,000, credit equity £5,000, owner invest. Second is a purchase equipment £1,500, equipment cash equipment is debit and credit because cash is going, so uh, credit cash will be credit. Cash is asset when asset decrease, its effect asset will be credit effect. Next is a transaction sales of £800 on credit, debit account receivable, and credit sale revenue 800. Then transactions 4 pay rent, uh, expenses increases. So accounts affect rent, expenses, expense, and cash assets. So journal entry debit, rent expense £300 and credit cash expense £300. Transaction 5, partial payment of £400 received from customers, cash assets and accounts receivable assets. So cash increase in assets and credit account receivables decrease in assets. So £400 debit, cash and uh, account receivable £400 credit as account receivable. Summaries of journal entries after recording all the transactions. List summarize the entries. Cash £5,000 debit, owner's equity or capital credit, equipment debit £1,500, cash credit £1,500, account receivable £800 debit, sales revenue £800 credit, rent expense £300 debit, cash credit for £300, cash debit £400, and finally accounts receivable £400 credit. Final balance £5,000 cash invest, uh, equipment minus £300 rent plus £400 cash customer payment is equal total. It's a 30 and 36,000. Oh, sorry, £100. Equipment is £1,500. Account receivable 800, £400. Payment receivable 400. Owner equity 5,000. Sales revenue 800 and rent expenses £300. So by processing these transactions through the double entry system, we can prepare the basic financial statement, the balance sheet and income statement with each transactions reflecting accurate balanced account. Balance business account. Now that we have calculated the final balance, we need to ensure that the business's account is balanced. This means that the total debit and credit should match. Confirming that all transactions have been correctly recorded, balanced business's account is essential to ensures accuracy in financial reporting, detect entry error in transaction recording, and prepare financial statements correctly. Example scenario: ABC supplies bank account. Let's take an example of a cash account for a business named ABC supplies bank account. ABC supplies which records transactions for a month, transactions of the cash account. So opening balance, the business starts with £2,000 in its bank account. Owner's investment, the owner's deposit £1,500 more into the business. Office rent paid, £800 for the office. Company pays £800 for rent. Customer's payment received. A customer pays £600 for a past sale, and suppliers purchase. The business buys supplies for £300. Record each transactions using the double entry system. We will record each transaction as a debit inflow or credit outflow in the cash uh, account. So the cash transactions are recorded in a ledger format, separating debits, money coming in, and credits, money going out. So here coming in, owner's investment £1,500, customer's payment £600, office rent is money is going out £800, and £300 purchases supplies. So balance total £2,000, then £3,500 extra, more investment, then minus £800 27, then plus 637, and then minus purchase supplies, so £3,000. So the cash accounts track all financial inflows and outflows, helping the business monitor available funds. Calculate the final balance. Total debit £1,500. Step 1, owner's investment plus £600. Customer payments minus £2,100. Oh, sorry, is equal to £2,100. Total credit cash outflows £800 rent plus £300 supplies purchase. A total is £1,100. So step 3, calculate the closing balance here. Opening balance 2,000. Total debts, money received £2,100. Total credit £1,100. So final cash balance 2,000 plus 2,100 minus £1,100, which is credit. So total, it's to confirm that the account is balanced. We check it's a £300,000. So to confirm that the account is balanced, we check that the final balance matches the calculated amounts. Since the final balance of £300 method, the expected total, we can say that the amount is properly balanced. So balance accounts shows that the balance records are correct, or business records are correct. There are no missing transactions. The business knows how much cash it has available. So this is an essential step before preparing financial statement like the balance sheet and income statement. Final cash account balance summary. At the end of the month, after recording all cash inflows and outflows, ABC supplies cash account balance stands at £3,000. The confirms the every transaction has been accurately recorded and the cash account is properly balanced. Right. Next, we will talk about trial balance. So if anyone is there, if anybody can tell me about trial balance, if anyone is there. Okay, no one. So trial balance basically is a financial report that lists all the accounts in the journal ledger along with their respective debit and credit balance at a specific point in time. So the purpose of this report is to ensure that total debits equal to total credits, confirming that final records the correctly balanced. Detect errors before preparing financial statement, provide a clear summary of all accounts balances for further financial analysis. Example scenarios of ABC suppliers again. Trial balance, assume ABC has the following accounts and balance for the end of amount: cash 3,000, debit account receivable uh, 800 pounds, supplies 300 pound, debit equipment 1500 pound, account payable 700 pound, credit owners equity 5,000 credit. You can call this capital as well. So sales revenue 800 pound, credit, rent expense 800 pound, debit. So these balance are then listed in the trial balance. If you look at here, uh, here in the trial balance format, showing which accounts are debit and which are credit. Like it, so look at here, 3,000 pound cash is debit, account receivable is assets and is credit, supplies 300 pound debit, 1,500 pound equipment, 800 pound rent expenses. Uh, it's rent expenses debit. So credit is account payable, owner's equity, sales revenue. So total 6,400 pound and 6,500 pound. So in this example, we find a discrepancy because the total do not match. So total debit is, if you look at here, uh, 6,400 pound and credit is 6,500 pound. So at first glance, we can see what the total debit amount 6,400 pound does not match the total credit amount. So this means there is a mistake somewhere in the accounting records. Since the trial balance must always be equal, we need to review the entries carefully to find the error. So basically here, mistake is here. Revenue was mistakenly recorded as 800 pound instead of 700 pound here. So sale revenues, basically, if you look at here, sales revenue is 800 pound. So this must be 700 pound. So this mistake caused the credit side of the overstated by 100 pound. To correct this, we adjust the sales revenue amount to the correct amount of 700 pound. Correcting sale revenue to 700 gives, if you look at here, sales revenue 700 pound. So now balance is 6,400 pound debit side and 600,400 pound for credit side. Final trial balance after correction, the debit and credit are balanced at 6,400 pound. A balanced trial balance confirms that all transactions have been accurately recorded. Secondly, the business accounts are correct and free from major errors. Thirdly, the financial statements can now be prepared with confidence. So if the remember, always remember that if the trial balance does not balance, it indicates an error that must be found and corrected before moving forward. Uh, so this was our trial balance. So calculate period and adjustment now. We'll talk about. So understanding period and adjustments, an essential part of financial accounting. These adjustments ensures that financial statements reflect the company's true financial position at the end of an accounting periods. In accurate accounting, revenues and expenses must be recorded in the period they are earned to or incurred, not when cash is received or paid. Adjusting for prepaid expenses. What are prepaid expenses? So first of all, we need to know that what are prepaid expenses. uh, uh, Prepaid expenses are, it's a very important a part of accounting, or very important topic, especially in term of exam as well. So prepared expenses are payments made in advance for goods or services that will be used over time, such as insurance, rent, and subscriptions. At the end of the period, we must adjust the record to show the portion of the prepaid amount that has been used. Here you can see ABC example as well. ABC Supplies purchased 1 year insurance policy on July 1st for £1,200. By the end of September, 3 months have passed, meaning a portion of the prepaid insurance has been used. So, step first, calculate the monthly insurance expenses and then record the adjustments. So, since £300 worth of insurance has been used, we must adjust the accounts. Debit, if you look at here, increase insurance expense £300, recognizing the used portion, then credit, decrease prepaid insurance £300, reducing the prepaid amounts. So this adjustment ensures that the financial records correctly reflects how much of the insurance policy has been used. So accrued expenses adjustment, accrued revenue adjustments. What is accrued revenue? Oh, sorry, what is accrued expenses? Accrued expenses are cost then a business has incurred but not yet paid. By the end of the period, these could include wages, utilities, and interest and expenses. Accrued revenues refers to income earned but not yet received. By the end of the period, businesses must record this revenue to accurately reflect earning in the correct period. Depreciation expenses and unearned revenue adjustments. So depreciation is the method used to allocate the cost of tangible assets over its useful life. We just discussed above as well. Instead of recording the full cost of an asset as an expenses in 1 year, businesses spread the cost over several years. Unearned revenue is money received in advance for goods or services that will be delivered in future periods. Initially, it is recorded. Initially, it is recorded as liability because the businesses still owes the services or products. So for this one, if you look at example, ABC Supplies received £600 in advance for a 6 month service contract in August. By the end of September, 2 months of services have been provided, meaning part of the advance payment is now considered earned revenue. So calculate the earned revenue, record the adjustment. So to transfer the amount from unearned revenue to earned revenue, debit unearned revenue £200 and credit service revenue £200. credit. Summary of period end adjustments. Again, prepaid expenses, debit insurance expenses, credit prepaid insurance, £300. Accrued expenses, wages, owing or unpaid, accrued, prepaid or paid in advance expenses, accrued owing, unpaid, wages expenses, accrued wages expenses, £400. Accrued revenue, unearned revenue, account receivable, service revenue, £500. Depreciation expenses, accumulated depreciation, £20, or unearned revenue, service revenue, £200. Right. Now, we will talk about financial statement, interpret financial statement to assess a business overall financial health. Financial statement provide essential insights into a company's profitability, liquidity, and solvency, helping business owners, investors, and financial analysts make informed decisions. To illustrate this, we will analyze a simplified income statement and balance sheet for a company called ABC Supplies. We are already talking about ABC. So, by examining key financial metrics, we will determine how efficiently the company operates, whether it can meet the short term obligations, and how well it manages its long term financial stability. Before interpreting financial data, let's look at ABC suppliers income statement and balance sheet for the year ending December 31st, 2023. So income statement here, if you look at revenue, £1,500, cost of goods 9,000, gross profit 6,000, 2,500, operating expenses, operating profit £3,500, £500 initial interest expense, and net profit is £3,000. So the income statement shows the company's earning and expenses over the year, revealing how much profit ABC Supplies made after covering all costs. So cash £2,000, account receivable £1,000, inventory £1,000, £4,000, equipment, total assets £10,000. If you look at liabilities and capital side, capital or equity size, account payable £1,500, account accrued expenses £500, bank loan £2,500, owner's equity £5,500, and total liabilities are £10,000. So the balance sheet provides a snapshot of the company's financial position, listing its assets when it owns and liabilities what it owes. So along with the owner's equity, now in next page we will interpret financial uh, you know indicators to determine the company's financial health. So profitability measures how well a company generate profit uh, from its sales after covering expenses. We will use three important ratios to assess profitability: gross profit margin, operating profit margin, and net profit margin. Gross profit margin interpretation: a 40% gross profit margin means that the for every pound of revenue 40p remains after covering production costs. So this includes the ABC supplies efficiently controls the cost of goods sold, keeping a healthy portion of its earning. Operating profit margin interprets 23.3% expenses. Such a operating profit margin shows that after covering operating expenses such as rent, wages, and utilities, ABC suppliers retains 23.3 pence per £1 of revenue. So this suggests the company effectively manages its operational cost. Finally, net profit margin interprets the 20% net profit margin means that the after accounting all costs including interest expenses, the company earns 20p for every £1 in revenue. This indicates strong profitability and efficient cost management. Liquidity analysis. Liquidity measures a company's liability to meet short-term financial obligations. Two important liquidity ratios are current ratio interpretation. A current ratio of 3.0 uh, means ABC suppliers has £3 in current assets for every £1 in short-term liabilities. The indicator strong liquidity showing the companies can easily cover its short-term debts. Quick ratio interpretation. A quick ratio of 1.5 suggests that even without relying on inventory sales, ABC supplies still has enough liquid assets such cash and receivable to cover its short-term liabilities. This reinforces a strong liquidity position. Next, solvency analysis, debit to equity ratio, total liabilities, owner's equity. So, solvency measures a company's ability to meet long-term financial obligations and manage debit effectively. Debit to equity ratio interpretation. A debit to equity ratio of 0.45 means that the every £1 of equity the company has 0.45 in debts. The low ratio indicates that ABC suppliers relies more on owners' investment rather than borrowing, making it financially stable. Interest coverage ratio interpretation. An interest coverage ratio of 7.0 means that ABC suppliers earn 7 times the amount needed to cover interest payment. This indicates that the company faces very little risk of financial distress. Now, we will talk about overall interpretation. ABC supplier is a high profitable with a strong gross profit margin 40% and efficient operating profit margin which is 23.3% and a healthy net profit margin of 20%. So these figures suggest that the companies effectively manage productions and operational cost, leading to good earnings, retentions. Number two, liquidity. With an current ratio of 3.0 and a quick ratio of 1.5, the company has more than enough assets to cover short-term liabilities. So this means ABC suppliers can easily meet financial obligations without cash flow issues. Solvency, the low debit to equity ratio 0.45 suggests that the company is not heavily dependent on debit and has a strong equity base. Additionally, the interest coverage ratio of 7.0 confirms that the companies can comfortably handle its interest payment, reducing the risk of financial strain. So, final conclusion, ABC Supplies is an excellent financial position with high profitability, strong liquidity, and minimal debit risk. This make it's financially stable and well prepared for future growth. Produce of financial statement. We will create a simplified income statement and balance sheet for fictional business XYZ Services Limited for the period ending 31st December 2003. So this statement will summarize the company's financial performance and position, providing valuable insights for stakeholders. The statement is used to calculate how much profit a company has made by subtracting its expenses from its total revenue. It helps businesses evaluate profitability and identify areas where cost can be controlled. So here, if you look at here is the income statement for XYZ Services Limited for the year ending 31st December 2023. So total revenue or total sale, £50,000. Uh, Less cost of goods sales 20,000, gross profit 30,000, less operating expensive, salaries 10,000, rent 3,000, utilities 2,000, depreciation 1,000. So total operating expenses are £16,000. So operating 30,000 minus 16,000, then operating profit will be £14,000, less expenses 1,500 pound, and total net profit is £12,500. So gross profit is was 30,000, then operating profit 14,000, and net profit is £12,500, if you see here. Balance sheet. Preparing balance sheet provides a summary of its company's financial position at a specific point in times. It lists when the businesses owns assets, what it owes, liabilities, and how much belongs to the owners, or equity or capital. So here is the balance sheet for XYZ Services, again XYZ Services Limited as of December 31st. So assets, there are current assets, cash 8,000, receivable accounts 5,000, inventory 7,000. So total current assets 20,000. Uh, then non-current assets 10,000, 15,000 equipment, property 15,000, 10,000 equipment, total non-current assets 25,000, and total assets current plus non-current assets are 45,000. Now, if you look at liability side, current liabilities, accounts payable, money on to supplies 2,000, expenses 1,500, total current liabilities 3,500 pounds, non-current liabilities, long-term debits, bank loan 4,000, non-current liabilities 4,000, total liabilities current plus non-current 7,500 pounds. Owner's equity investment in banners is 37,500 pound. Total liabilities and equities 45,000 pounds. So XYZ Services Limited is an excellent financial position showing profitability, strong liquidity, and low debit dependency. This makes it a financially healthy company with the potential for future growth and expansion. So basically, financial statement shows that, as I said, a net profit for trend is showing a strong balance sheet, high owners equity, uh, adequate liquidity with current assets overweighting current liabilities, indicating the ability to meet short-term obligations. So these financial statements provide a comprehensive view of XYZ Services Limited financial performance and financial position as of December 31st, 2023, offering a snapshot of profitability, liquidity, and solvency. So here some references. Here is, and also that some books recommended for you guys. If you visit Moodle, you can get some uh, further more materials about financial accounting. So in today's session, that's it, guys, for today. Thank you very much for joining me for this evening. So in today's session, we learned how to produce and interpret financial statement, covering both the income statement and financial statement, income statement and balance sheet. We examined how businesses record their revenues, expenses, assets, and liability, and how to use financial ratios to assess a company's profitability, uh, liquidity, and solvency. So, thank you. Thank you for your participation today. If you have any questions or need any further clarification, feel free to email me at yasser@ukversity.co.uk. So, thank you for today uh, session, and I look forward to our next session where we will continue exploring key accounting principles. So see you tomorrow at 6 o'clock for our final session. For tomorrow we will discuss assignment. So our tomorrow session is a assignment session. So thank you very much till tomorrow. So I'll see you tomorrow at 6 o'clock, everyone, and have a good evening and bye for now.